Now, between them, commercial and private vehicle insurance accounted for the top loss ratios in Kenya's insurance sector last year at 55.9% and 76% respectively. That, however, didn't stop one company from offering a micro-insurance product that caters to the emergency medical care needs of passengers for less than $1 per person per trip. When I spoke to the Resolution Insurance CEO earlier, I asked him how he approached working in an industry with a less than stellar public image.
Disorganized organization.
But how does that work? I mean,
it's very interesting.
But that's the thing, because a product like this, even just at face value, given all the information that was in the public domain,
right.
After its launch, would never have worked unless these guys had a buy.
Yes. When we cracked that you need to put incentives through that particular value chain, is how we realized that this product is likely to work. We went and studied. They're very well organized. First of all, you realize you can't just get a vehicle and get into a route. Yeah. There's a route organized. There are some routes also where they know the drivers who drive badly and they punish them and the owner gets punished. They have route inspectors. And then they have data. They just don't know what to do with that data.
So it's a question of they're pretty much sitting on assets.
No one approached them.
That they're not sure how to use.
No one asked them.
So, okay. Walking back to it, I mean, when you're selling this idea, because the product is sold essentially to passengers.
No passenger.
Why not cross-sell it with a PSV? So, like, if I'm buying a ticket for Nairobi, Mombasa, or Nairobi, Nakuru, if I'm going on holiday, right, why shouldn't that be bundled into the cost of the ticket?
We did consider that. The problem with, if you bundle it, the cost of transportation goes up in the eyes of the consumer. That's one. Second, mandatory. You almost make it mandatory that anyone taking this PSV. Yeah. Third, cannibalizing other insurance products. So the people who are in the public service vehicle, but they're covered through their employer, through NHIF and all that. Yeah. So we decided, look, let's separate it. But then get the person promoting the product to be the owner or the route owner. Now, the incentive for the conductor and the bus driver is they don't have to pay insurance. We give them a threshold. If your vehicle reaches this threshold, you're covered for free. So that's the incentive. And these incentives are built in a way that from the route owner, from the organization, the Matatu owner's organization, to the dealer, they have a skin in the game to control risk and then to make revenue. So it's a revenue share model.
The public transport model in East Africa is roughly the same.
About the same.
Uganda, Tanzania, Rwanda, roughly the same. So how fast are you going to roll that out? And two, just in terms of what this will add to your premium collection, right? Especially in terms of earned premiums. Give us some numbers on that.
Okay. Let me start with the easier one. We've already started exploring it in Dar es Salaam, now because of the Dar Rapid Transport. Yeah. We haven't started in Uganda, but we will get in there because we're just sorting out our licensing issues in Uganda. The numbers depend on the conversion rate. Let me give you an example, and we are coming from different sides. Yeah. Matatu owners believe they can do 50% conversion rate. If you do 50%...
Wait, sorry, when are you talking about 50%? So it's 50% of everyone...
the vehicle, of the numbers in the vehicles,
will have
the product.
Okay.
That in 2 years' time. If you do that, it's 20 billion shillings a year.
Christ.
Okay? If you do a 10% conversion rate, you come to do about 7.8 million shillings. So, billion shillings. So we are looking from anywhere from $1 billion shillings to 20 billion as a possibility.
But what about the loss ratio involved? Because I mean, for motor vehicle insurance, it's scary. You see that in
such low loss ratios. I'm not sure I can even say it on air because that was the challenge of the regulator. They're saying the loss ratios are so low. In fact,
and your pilot model actually demonstrated
that. The loss ratios are very, very low. I don't want to mention how low they are. The regulator said, look, when it gets traction, you have to reduce the price. Because the majority of the money goes through the structures that we put of incentive, the distribution. But if you understand micro-insurance, the loss ratios are usually low.
Yes.
It's the cost of distribution that goes up.